is Scott Newbold, and I am a certified financial planner here at MHA Caves Wealth. During this training video, we will be discussing venture capital trusts, sometimes otherwise known as VCTs. I am joined today by Martin Perrett, Senior Business Development Manager at Blackfinch Investments. How are you, Martin?
I'm very well, thank you, Scott. Yes, not too bad at all. How are you?
Yeah, good, thank you. So today we'll outline a few different areas surrounding VCTs, and I think a good place for us to start would be with the main question of what is a VCT, and can you tell us a little bit more about them, Martin?
Absolutely, yes. So a VCT is, or a venture capital trust, is an investment opportunity that clients can invest into as a way of reducing some income tax relief. It was first actually introduced by the UK government back in 1995 as a way of early stage and growth stage businesses being able to access retail investment. And for doing so, the government provide generous tax reliefs for the clients that are investing into them. The VCT itself is a bit like an investment trust, and it will sit on the London Stock Exchange, and clients that are investing into a VCT will be buying shares in that venture capital trust itself.
Perfect. And one of the main sort of tax benefits that are typically seen alongside VCTs are a 30% income tax relief. How would a client go about reclaiming this? And also, are there any other tax advantages of a VCT?
Yeah, that's a very good question, and you're absolutely right. The headline 30% income tax relief is often the key thing that a lot of people are familiar with. Just to put some further meat on the bone of that, so the 30% income tax relief is against any investment amount that you make in any one given tax year. You can invest up to £200,000 per annum into a VCT. You can only obviously claim back as much income tax relief as you've actually paid. So you can claim up to £60,000 of income tax relief if you invest the full 200. But obviously, if you've paid less in income tax, you wouldn't be able to reclaim more than you've actually paid. It's deemed a tax reducer. In terms of reclaiming the income tax relief, it can only be claimed against the tax year in which you make the investment. So, for example, if you made an investment now into a VCT, that would mean you can reclaim income tax relief for income tax paid in the 2022-23 tax year. So in terms of claiming the income tax relief, clients have a couple of options. They can either reclaim the income tax relief via their self-assessment tax return, or they can change their tax code if they are PAYE employees. Normally what they would have to do is write to HMRC with their national insurance number, their P60 form, and their VCT share certificate in order to make that change. But basically, once you've invested into the VCT, you will be issued a VCT share certificate, and it's that certificate that will need to be submitted to HMRC, whether via an ad hoc submission for PAYE or via the self-assessment tax return, in order to claim that income tax relief back. Going on to your final question, in terms of what the other income or what the other tax benefits are with the VCT, obviously the 30% income tax relief is the main one, but you can also benefit from tax-free growth and tax-free dividends. So to put that into context, if the client were to invest, say, £10,000 and sell the investment further down the line for £20,000, that £10,000 growth would be exempt from capital gains tax, and any dividends that are distributed from the VCT would be free from dividend tax.
Perfect. And in terms of a typical VCT client, what would they look like?
So we see a few different types of clients investing into VCT. I'd say probably the main type of client we see investing is a client that has a very high salary and that has a significant income tax liability. So they may look to invest into the VCT purely as a way of reclaiming some income tax relief that they've paid in any given tax year. Other types of clients that we'll see investing into the VCT include clients that may be approaching their lifetime allowance for their pension or have reached their lifetime allowance for their pension. So rather than directing funds into their pension, they would direct it to a VCT instead for the 30% income tax relief and those tax-free dividends. And again, another type of pension client we'll often see is any clients, again, if they're earning significant amounts in terms of salary or bonus, and they are then restricted by the tapered annual allowance for pensions, where they may only be able to pay £4,000 into their pension, they may decide to direct some funds towards VCT, again, for those tax benefits that we've already discussed. The final one we see is probably business owners or directors of companies that may look to take dividends out of the business. Obviously, by taking a dividend out of the business, they will be subject to dividend tax at their highest marginal rate. But if you then invest those proceeds into of the dividend into a VCT, you'll obviously benefit from the 30% income tax relief, which can be used to offset some, if not all, of the tax paid on getting the dividend out of the company. So it gets corporate money into personal pocket, shall we say.
Perfect. And typically VCTs are deemed as high-risk investments. How would you go about mitigating those risks for an investor?
Yes, that's a good question. VCTs are indeed deemed higher risk investments, and that is because you are typically investing into an early stage or growth stage company. The whole reason that the government give away the 30% income tax relief is because they are wanting you to take a risk with the investment and making that investment into early stage companies. So what we look to do at Blackfinch, and many other managers will do similar, is firstly look to diversify the portfolio as best as possible. So we aren't just investing in one company. You know, if that one company was to go wrong and you were only invested in one company, then that's when something could be quite catastrophic. So what we look to do is invest in multiple different companies across various different sectors so that we can widen the scope of companies that are invested into within the VCT. So typically a VCT would have anything from maybe 20 to 60 different underlying investee companies in terms of a diversification for clients. Obviously, we as well have a thorough due diligence process and a very experienced team in-house that have got extensive experience in early stage and growth stage businesses. So we look to make sure we're working with the best companies possible, with the best founders that have got a real chance of making that step up the growth curve.
So it won't be that a client is investing into just one high-risk company?
No, definitely not. No, they invest in the VCT, and then the VCT will deploy that capital across, a multitude of different companies. With ourselves, for example, we have circa 20 companies in the VCT as it stands at the moment, and we look to deploy into between 5 and 10 per annum. So over time, that will, widen even more substantially. So that diversification will grow as the VCT grows too.
And in terms of VCT, they have a holding period of at least 5 years. Are there any liquidity issues, and how do clients go about getting their money back at the end of that 5-year term?
That's a very good question. So VCTs should be deemed a medium to long-term investment. So in order to get the 30% income tax relief, you would have to hold the shares for at least 5 years. So clients should really view them as not wanting or not being able to access them within that 5-year period. If you do sell your shares within 5 years, you would actually have to repay HMRC any of that 30% income tax relief that they gave you at the outset. So ideally, that's not something that you'd want to do. But most VCTs will offer what's called a share buyback facility. So pretty much throughout the year, other than for 2 points when the accounts are often compiled, there will be the ability for the VCT to buy back the shares from the client to create liquidity, or clients can sell their shares on the secondary market.
So when Blackfinch are investing into these companies, when you give them the investment, do you just give them the investment and allow them to kind of just get on with it? Or do you provide support to those businesses and the business owners within them?
Yes, absolutely. Obviously, what we are looking to do is help that company succeed, and we want to drive the best value possible from that potential underlying investee company. So yes, we work with them extensively throughout the investment lifecycle. One of our expert team in-house will sit on the company as a board observer and will be there to provide advice and guidance throughout the investment cycle. But what we will also do is look to appoint what we call a venture partner onto the board as a full board member of each company. So they're basically like a non-executive director, and they will typically be external from Blackfinch, and they will be industry heavyweights in their own sectors. And they too will provide their, firstly, black book of contacts in terms of helping that company grow, but then also their expertise as well. So yeah, we aren't just giving them the cash and then asking them to come back in a few years' time. We're working with them very closely throughout the investment cycle, monitoring their KPIs, all of that type of thing, and providing the advice and support where required.
And in terms of investments generally, we are seeing more clients that are wanting to invest in line with ESG views. How would you go about considering those views for a client?
Again, yeah, very good question. ESG or environmental, social and governance factors are something that have become a lot more apparent and prominent in the last few years. It's something that we at Blackfinch take very seriously, and we have a full ESG overlay across all of our investment mandates, not just the VCT, but of course we do take that into consideration. We invest in companies that can make a real difference in the world. With that commitment to ESG and our technology-focused mandate, we support firms that are really breaking into new ground. We target them at an early stage across sectors with that technological capability. And these firms are innovating products that really do address real world needs. Many of them are, set to change the way we live and work. And what we want to do is ensure that ESG and sustainability are properly considered in all of our work. And whilst we're not, I guess what you'd call an impact fund, because there are different definitions of ESG, whilst we're not an impact fund, we strive to ensure that every portfolio company makes at least a small net positive and sustainable contribution to the world. So we look at everything from the central purpose of the business, that must be worthwhile in some small way. There must be an economic benefit too. We consider what the business does and plans to do. We look at how the business is conducted, what the management team is like, especially for that governance point, and also the attitude of the team, the board, and especially the founders, and what their commitment also looks like to ESG, so that we're all on the same page.
So Martin, we're now seeing a lot of clients with EIS portfolios, and EISs have lots of tax advantages. Why would you not consider using an EIS before a VCT?
Yeah, it's a very good question. The EIS is a fantastic tool for tax planning. And as you say, there are significantly more, tax reliefs that you can benefit from with an EIS over a VCT, but it will ultimately come down to the client's individual circumstances and what they're looking to achieve. So with a VCT, as we alluded to earlier, you are typically benefiting from that income tax relief for the year that you make the investment. And then you are also likely or hopefully able to receive tax-free dividends and tax-free growth. Where we see some clients perhaps considering EIS instead of VCT is actually if they are needing to reclaim income tax relief from a prior tax year. And what I mean by that is with a VCT, you can only reclaim the income tax relief in the year that you make the investment. However, with an EIS, you are actually able to reclaim income tax relief for the year that you make the investment, or go back to the previous tax year. So again, it's a 30% income tax relief, but you can choose whether to do it for the current year or the previous year. So again, if you were to make an investment now into an EIS, you could potentially reclaim income tax paid in the 2021-22 tax year or the 22-23 tax year. So it gives clients the availability or option to go back that one tax year to reclaim any income tax relief that they couldn't at the time. What it's also what you're also able to do with an EIS is defer a capital gain. So if a client has sold an asset or maybe a share portfolio with a significant capital gain, then they may decide to reinvest that gain into an EIS. And that means that the gain would be then deferred for the life of the EIS investment. So some clients will look to benefit from the CGT deferral point. That's something that you can't do with a VCT. The other core benefit of an EIS is that you are typically a direct equity holder in the underlying company, and those underlying companies will be trading businesses. So they should qualify for something called business relief. And with business relief, what the legislation says is that if you hold business relief qualifying shares for at least 2 years and at the point of death, then the value of those shares will be exempt from inheritance tax. EISs will typically qualify for business relief. So not only can you get the income tax relief, the capital gains tax deferral, you can also potentially qualify for inheritance tax relief too. So it may well be that clients will look to benefit from a combination of those, or they may have, again, depending on their circumstances, it may be that one of those areas makes them more attractive than a VCT, because a VCT, you can't do the CGT deferral and they don't qualify for inheritance tax relief. The other thing as well is that's often important to consider is risk. And what we often will find, or what you will often find, is that with an EIS, the investment manager will probably be looking at companies that are slightly earlier in terms of their life cycle. So they might be slightly higher risk, and therefore there's a greater or a higher chance of them failing. So VCTs will maybe be more established companies that are slightly further along their growth journey up the growth curve. So therefore you could perhaps argue that they're slightly lower risk because the companies are more established. But that really will depend on each individual manager and what their underlying investment strategy and philosophy looks like.
That's great. Thank you for your insight today, Martin, and for taking part in our VCT training video. Should anyone watching today have any questions regarding VCTs or financial planning in general, please do not hesitate to contact us and we will be more than happy to help. And lastly, thank you all for listening.